What if I told you that in a single 24-hour window, $229 billion worth of leveraged crypto positions got absolutely vaporized? Not over a week, not over a month, but in one day? That's not a market correction. That's a financial pressure washer, pointed directly at the faces of everyone who borrowed too much to bet too hard. Let's talk about what actually happened, because the number that matters almost as much is $93 billion. That's where industry open interest in crypto futures landed after the carnage, and open interest is basically the scoreboard showing how many leveraged bets are still alive in the market. When that number drops fast, it means traders aren't just losing money, they're being forced out, margin called into oblivion. Their positions closed, whether they like it or not. Now, here's the mechanic you need to understand. When a market moves against a leveraged position, exchanges automatically liquidate it to protect themselves, and those forced liquidations create more selling pressure, which triggers more liquidations, which creates more selling. It's a doom loop, a financial avalanche, where the snow itself is made of other people's debt. Think of it like a crowded theater where someone yells fire, except in this version, everyone is also chained to their neighbor, so when one person runs, they drag the next person off their seat. Long positions took the brunt of it this time, which tells you the crowd was leaning heavily bullish going into the drop, everyone was positioned for the party to continue, and then the DJ cut the music and the lights came on. That asymmetry matters enormously because it tells you the direction of the trapped money. And trapped money, when it finally gets freed by liquidation, tends to exit in a way that amplifies the very move that hurt it. You could see the stress spreading everywhere you looked in the derivatives market. Open interest fell not just in Bitcoin or Ethereum, but across meme coins and most of the major altcoins simultaneously, which is the market equivalent of every single table at a casino going cold at the exact same moment. That breadth of decline signals this wasn't selective profit-taking or smart rotation. It was a system-wide de-risking event driven by fear, margin calls, and the very human desire to just make the pain stop. Then you look at Deribit, which is the largest crypto options exchange. And the story gets even more interesting because puts were pricing more expensive than calls. That's called negative put-call skew. And it's the derivatives market whispering that sophisticated traders are willing to pay a premium to protect against further downside rather than speculate on a bounce. Implied volatility was falling at the same time, which sounds contradictory, but it actually means the panic buying of downside protection had already happened. And what you're seeing now is the aftermath, a market catching its breath after sprinting in terror. Funding rates are the other piece of this puzzle you absolutely need in your toolkit. Because in perpetual futures markets, when longs outnumber shorts, longs pay shorts a periodic fee to keep the market balanced, and when that rate flips negative, it means the crowd has shifted to net short, which historically has been one of the most reliable contrarian signals for a bounce that exists in crypto. A deeply negative funding rate is basically the market paying you to be optimistic while everyone else is curled up in a corner. Here's the beautiful and slightly absurd irony of all this. The very leverage that lets traders amplify gains on the way up becomes the mechanism that forces them to sell at the absolute worst time on the way down, accelerating losses for everyone holding spot positions who had nothing to do with the futures market at all. You didn't even have to be playing the leverage game to get hurt by other people playing the leverage game, which is either a profound lesson in systemic risk or just the universe being its usual chaotic self. Historically, crypto has done this dance before the summer of 2021, saw similar cascade liquidations. The November 2022 FTX collapse produced comparable open interest collapses, and each time the pattern rhymed, even if it didn't repeat exactly. The lesson from every one of those cycles is the same. The exhaustion of selling pressure tends to show up in the data before it shows up in the price, and derivatives metrics are your early warning radar. One of the biggest misconceptions people carry into these moments is that falling implied volatility means everything is fine and the danger has passed, but what it actually often signals is that the acute panic phase is over, not that the path forward is clear or easy. You want to see open interest stabilize and rebuild. Funding rates normalize from deeply negative back toward neutral, and put call skew compress, before you start treating a bounce as a new trend rather than a dead cat with ambitions. The practical playbook here isn't complicated, but it requires the emotional discipline of someone who can watch their portfolio bleed without reaching for the sell button at exactly the wrong time. Watch for open interest troughs combined with negative funding and elevated put. Call skew as a cluster of signals that exhaustion may be near. When those three align, history suggests the risk-reward of a measured, sized entry improves meaningfully, not because the bottom is guaranteed, but because the leveraged sellers who were going to sell have largely already been forced out. Position size is the variable that separates people who use these signals profitably from people who use them correctly and still blow up knowing the signal is one thing, but betting 70% of your portfolio on it because you feel confident is how you turn a good read into a catastrophic outcome. Smaller entries, defined risk, and the patience to add only as the thesis confirms are the unglamorous mechanics that actually produce results over time. What this whole episode really teaches us is that markets aren't just driven by fundamentals or narratives. They're driven by the structure of who is positioned where and with how much leverage. And understanding that structure gives you a genuine informational edge over the person who is only reading headlines. The derivatives market is essentially a live map of crowd psychology expressed in dollars, and learning to read it is like being handed the emotional X-ray of every participant simultaneously. So when you see the next wave of open interest collapsing and liquidation spiking, don't panic and don't chase, treat it as data, because that's what it is, and data processed calmly is an asset, while data processed emotionally is a liability. Discipline, sizing, and consistency aren't the exciting parts of trading, but they are the parts that are still standing after every single storm this market has ever produced. And if you're watching all of this from the sidelines, wondering how to get started building real, durable wealth outside of the volatility roller coaster, whether through real estate investing, home contracting projects, or connecting with the right lenders, check out our links in the description below.